Housing is the only market where affordability can collapse, and prices still refuse to behave. Rates go up. You expect prices to drop. Instead, the market often just freezes. Today, I'm going to show you why. Housing isn't only supply and demand. It's policy plus credit plus a lock-in trap. And once you see the mechanics, the headlines start making a lot more sense. By the end, you'll know what keeps prices sticky and what would actually have to happen for a real decline. Here's the core idea. When the price of bananas goes up, you buy fewer bananas. Simple. Housing isn't priced like that because the price you feel isn't the sticker price. It's the monthly payment. And the monthly payment is controlled by interest rates and credit rules. In other words, housing prices are the financing system wearing a house costume. And that's why rates up equals prices down is often the wrong shortcut. If houses were sold like a Netflix subscription, prices would adjust every week. But housing is sold like a 30-year contract. That changes the physics. Now, let's break it down into the mechanisms that make housing prices sticky, even when you expect gravity to win. Mechanism. Supply is slow, political, and sticky. Yes, supply matters. But supply doesn't move like people think it moves. In a lot of places, you can't just build more on demand. Supply is constrained by zoning, permitting, labor, materials, land, infrastructure, and honestly, local politics. That means new housing arrives slowly, unevenly, and often years after demand shows up. So when demand changes, the quantity of homes can't respond quickly. Prices respond. And here's another piece people miss. When the market softens, builders don't behave like a clothing store doing a clearance sale. They often pause projects. They wait for conditions to improve. They protect margins. That keeps supply from suddenly flooding the market. In a normal market, prices fall to clear inventory. In housing, the inventory often never even gets born because it gets blocked in permitting, or delayed until the cycle turns again. So even if demand cools, supply doesn't automatically surge to meet it. The market can just slow down. Rates don't just hit buyers, they trap sellers, the lock-in effect. This is the mechanism that makes the whole thing feel unfair. Millions of homeowners locked in low mortgage rates. If they sell and buy again today, they're not just switching houses, they're trading a cheap loan for an expensive one, and that can explode their monthly payment even if the next house isn't much nicer. So what do? They don't list. They stay. They renovate. They make the spare room into an office. They tolerate the neighbor's drum set. That's the lock-in effect. Higher rates can reduce the number of people willing to sell, which reduces listings, which reduces supply exactly when you'd expect more inventory to show up. So yes, higher rates can cool housing, but sometimes they do something else. They freeze it. Like a broken elevator, nobody goes up, nobody goes down. Transactions drop, activity drops. But prices don't collapse the way you expect, because the homes simply don't come to market. Mechanism. Credit standards and payment math create a price floor. When rates rise, affordability gets crushed. But affordability collapsing doesn't automatically force a crash, because the buyer pool doesn't just shrink, it also changes. As lending tightens, weaker credit buyers get pushed out first. The remaining buyers tend to be higher income, larger down payments, dual income households, or cash-heavy buyers. So demand falls, but it becomes harder to shake. That can create a kind of price floor. Fewer buyers overall, but a more resilient set of buyers left standing. And remember, sellers don't cut just because buyers complain. Sellers cut when they have to. If you don't need to sell, you can list high, wait, pull the listing, rent it out, or just stay put. Here's the blunt version. Housing clears on forced selling, not vibes. If jobs are okay and most owners can still make payments, they can wait you out. Mechanism. Investors plus policy. Now we get to the uncomfortable tension. Housing is shelter, and housing is an asset. That's not a moral statement, it's a mechanical one. Investors show up when rent is rising, when inflation feels sticky, and when housing looks stable relative to other assets. And policy can reinforce that stability in subtle ways. Financing channels, tax treatment, and local rules that restrict new supply. Put it together and housing behaves like a hybrid. Half home, half portfolio. And asset markets don't fall just because people want a discount. They fall when financing breaks, income breaks, or supply overwhelms demand. Housing isn't a pure free market. It's a market inside a cage built from loan terms and zoning. So why don't prices fall like you expect? Because the usual market correction story assumes three things that are often not true in housing. Supply can quickly increase. Sellers will list when conditions worsen. Buyers and sellers respond the same way as in normal retail markets. In reality, supply is slow. Sellers get trapped by rates. Credit filters the buyer pool. And policy shapes the whole playing field. That's why the most common outcome during rate hikes isn't always a crash. It's a grind. Fewer transactions, sticky prices, and a lot of frustration. And here's the first joke, because it's painfully accurate. If housing were a person, it wouldn't break down. It would just leave you on red and reply next week with a higher price. What would actually make prices fall? If you want a real, broad housing price decline, not just a few listings with price cuts, you typically need one or more of these triggers. A true surge in supply, not just more building, but enough new supply to overwhelm demand in a meaningful way, especially in the places people actually want to live. Forced selling, job losses, distress, major payment shocks, resets, or a credit event that forces owners to sell. This is the big one historically, because it creates inventory that has to clear. Rates staying high long enough that lock-in fades. Over time, people still have life events: divorce, kids, job moves, aging, death. If rates stay high long enough, more owners eventually have to transact, even if it hurts. That can loosen the freeze. Policy shifts that change the game. Policy that meaningfully expands building, reduces bottlenecks, or reduces speculative pressure can alter the long-run path. It's slow, but it matters. Without some mix of those, you often don't get a dramatic drop. You get the boring outcome. Fewer open houses, fewer listings, and the same prices staring back at you. And here's the second joke, light but dead on. People say, just wait for the crash. Housing heard that and said, best I can do is fewer open houses. The takeaway, so the next time someone says, rates are up, prices should fall, you can answer with the actual mechanism. Rates don't just hit buyers. They trap sellers. Supply is slow and constrained. Credit filters demand into a tougher buyer pool, and policy shapes the entire playing field. Housing is a market, but it's also a policy outcome. In the next video, we'll connect this to the bigger system: how the Fed moves housing without touching a single house by changing the cost of money, the rules of credit, and the behavior of sellers. If this helped you see the system instead of guessing headlines, subscribe and drop a comment. In your area, are you seeing a true freeze or real price cuts?